Welcome back to part 3 of the liquidity series. So in the last part, the advanced liquidity video, which is part 2 in this liquidity series, we briefly introduced you to the concept of liquidity traps, inducement levels, inducement zones. And what we are going to do now is we are going to dive deeper into it, because understanding this is crucial for you not to get stopped out unnecessary and find those perfect spot on entries. If you know what the market makers are doing, then you know what you got to do. And it's like I said in the previous video, you get the big sharks in the market and they are the market makers, and then you get the small fish, and that is us, and we swim in their direction and we eat the crumbs that comes from the market makers moving the markets. As long as we can understand and accept this, we will make money in the markets. All right, so let's dive into this. So what is an inducement level in the market, or an inducement zone? It's basically a trap. It's a liquidity trap. It's a zone or level in the market where the market makers, the institutions, wants you to put orders. So they induce you to put orders there on purpose. And it can be anything. It can be a resistance line. It can be a support line. It can be a trend line. It can be a swing high, swing low. It can be an order block even, equal highs. All of that is inducement levels that is perfect for market makers to come and sweep liquidity, sweep out the stop losses. So how can this look like? Let's look at it. Support and resistance inducement. Let's start with that. That is the most classic and the most usual for retail traders to get stopped out on. So the blue line represents our resistance level. And when we have hit it 1 time, 2 time, 3 time, the 4th time the market is coming up here, what are we going to think? This is a super solid resistance zone. But every time we have hit it, we have also put stop losses here. Sell orders, stop losses. Sell orders, stop losses. Sell orders, stop losses. We come in there again. Of course, sell orders, stop losses. And even the 5th time, we're getting greedy with it. Market comes here and it looks like it bounces off the resistance, which induces people to put their sell orders and stop losses. And then what does market do? Market shoots up, sweeps this whole liquidity zone here, this whole liquidity pool. What it does then is sweeps back down again. And you got to understand, when market shoots up like this, buyers in the market, what do? Aha, I knew it. This time market is breaking through, breakout, and they enter it with their stop losses underneath. Buy orders, which catapults the market even more. It propels the momentum. And what does market do? Comes back down and sweeps all these stop losses as well. That is support and resistance inducement, and something you really got to watch out for. This is how most retail traders get stopped out in the market. But when you learn to understand that this here is a stop hunt, you see in all these levels, and you understand that here is a fat ass liquidity pool. Market will want to come and sweep this liquidity pool. And you see this big institutional candles shoot through, you understand that this is a liquidity sweep, and you're waiting for the reversal. And when you see this starts to happen, you can be ready to put your sell orders, because you know that this is going to shoot down. Then we have the trend line inducements, and the blue line here represents a trend line inducement, and that is also classic. So what does market do? Comes here, respects the trend perfectly. Okay, perfect. Comes here again. Retail traders think that, all right, this will bounce off again, and probably. Nah, what does it do? It shoots straight through, sweeps liquidity. All these stop losses here get stopped out. And now we're on the sell side of the trend line. Again, bouncing off, bouncing off, bouncing off. Sellers putting the stop losses. Sellers put in the stop losses. Same thing again, sweeps the liquidity. All this liquidity swept. Bounces off, sweeps the liquidity from all the stop losses underneath. And so we can do back and forth, back and forth. This is also a form of range. This is also a form of accumulation zone, just that it is trending. This one is bearish, it's downward sloping. So it's a downtrending accumulation zone. And this is one of the main reasons why we in Prosperous, when you're trading with our strategies, we don't trade trend lines. We trade trends, definitely, most definitely. We always follow the trends. The trend is your friend, but we don't trade trend lines. We don't enter or exit positions according to trend lines. Then we have something called swing inducements. And we already looked at this a little bit in the previous liquidity video. But let's dive deeper into it to truly understand it. So all of this here is ranging. Market is ranging, accumulating. But same thing like in the previous example, is accumulating in a downward sloping trend. But this is a more aggressive range and actually also a trend, considered a trend. Why a trend? Because market, of course, is moving down. It's creating lower highs and lower lows, right? But the aggressiveness in the swings, the way it swings, and you see all these institutional candles, you see that this market is heavily manipulated and is pushed by big money, smart money, and leaving this big wicks behind. So all of this is inducement levels, liquidity. Every time market swings like this and creates a lower low, new retail traders come in and think that, oh, perfect, we're selling off. Market is going down. But even before the whole market turns like here and sweeps all this liquidity that is collected here, even in between here, you can see a lot of liquidity sweeps. Here looks like the market will turn, boom, it pushes down, comes back up, sweeps the liquidity, pushes down, comes back up. You see all of this is inducement. All of this is market makers creating liquidity pools. So it's creating a lot of liquidity and eating it along the way. This whole process here is actually accumulation of liquidity, and in the same time creating liquidity that is laying above as stop losses. That market that comes and sweeps in one push. And I want you to observe also this yellow striped line here. Why did I put it out there? Because I want you to show how perfectly market came up just above these highs here. Because just above these highs, what do we have? All the stop losses from the sellers. All right, so here's a lot of liquidity. And market comes first perfectly equally to these highs. And sellers think, oh, perfect. We're dropping down from here. More liquidity. And then it does one more push and sweeps all the liquidity that we got here. And then the new downtrend starts. New accumulation. Last but not least, we have the order block inducements. And it's not just order block inducement, but it's kind of a smart money inducement levels. Why do I call it smart money inducement levels? Because people trading the smart money concept will be induced into this if they don't understand it properly and have good experience in the markets. So what do I mean with order block inducement or smart money inducement? Well, you see this order block here. We have a nice little order block. Market comes down, creates a high, comes down, does its thing, comes back up, creates an equal high. Sellers from here and sellers from here have their stop losses. A nice little liquidity pool. Market pushes down, then comes back up with a lot of momentum, creating all these institutional candles, and sweeps straight through these highs, breaks these highs, sweeps this liquidity, comes into this order block. But here's the thing. What do we have? We have another order block just above it, an engulfed order block. Where's that order block laying? Just above the previous order block that is very obvious for smart money. So this is why I call it a smart money inducement level, because you see these equal highs. Is very popular for smart money traders to understand that this is an inducement level, and they will not put their sell orders next time the market comes up here. Okay, good so far, because they know that this will be an inducement level with liquidity above. So where would they put a sell order? At the next order block. But the thing is, the market makers knows and understand this. So they know that there will be a lot of sell orders laying here as well with stop losses here. But if you look a little bit higher, then you will see the next order block. And this is actually the order block that you should watch for. And what does market do? Comes up, pushes straight through this whole liquidity zone here, pushes straight through this whole liquidity zone, taps into this last order block, and then pushes down. Now, in a situation like this, it's easy to say it, but it's hard to do it in the real market. So how will you understand the market will push up all the way here? Well, the real truth is you don't know. You can only guess. Trading is calculated guesswork with the art of having the probabilities on your side. So when you see these kind of inducement zones that you think is high probability inducement zones, what you do is you look at how the market moves. I would never put a sell order here, a sell limit order, or a sell stop order, whatever. I would wait for the market to push up here and see how it pushes up. If I see this candle here, we already know by now that this is an institutional candle. If I see this type of candle with a lot of momentum and volume, I will not sell from here. I will first wait and see how market reacts to this level. Then what happens? Next candle not as much momentum. Next candle actually tries to push down but fails. The sellers were not strong enough. They need a little bit more liquidity, so market pushes up a little bit more, and that if I see this candle, I'm definitely jumping in, because now I know market is indecisive. It wants to push down, but it doesn't have enough momentum, enough volume, enough liquidity. But here we have the liquidity inside this order block, right? So that's the last liquidity it needs to do the push down. So here I will be waiting with the sell after seeing these candles form. Now, all of this explained here comes with experience. You have to watch the market. You have to spend hours on the charts and watch out for this all the time. Go back to this PDF, go back to the video, and try to recognize these patterns, these inducement levels, these market moves, and always watch out for these institutional candles. If you see a candle like this, always think, why did all this big money come in here and started to push the market? Because we retail traders cannot create candles like this. Only the institutions can. You have to push in hundreds of millions in the market to create this, especially if it's a big market like gold, Euro USD, and so on. So as I'm always saying, study these videos until you properly understand the concepts and the terminology. Go to the charts, study them, learn to understand them, back test them until you start to see that you are predicting the market moves ahead, and you are getting a higher and higher accuracy in predicting what the market is going to do. When you can predict liquidity sweeps, then you have made it quite far as a trader. And with that said, I'll see you on the next one.